going to be a massive recession this year in Europe. What other things can the European Investment Bank offer Europe on its own without sort of help from the European Central Bank or other institutions?
Well, of course, we could expand the program that we have just proposed, this 20 billion package with a leverage factor of hopefully up to 8. Of course, one could do more of this, but then you need the backing through a guarantee mechanism like the one we have now with the member states who pledged 25 billion. One can do more. On the other hand, we know that one day we will stand in front of a huge mess when it comes to the recovery of Europe. And then I think the bank will need to go full speed. That requires then definitely the capital injection into the institution, which is probably the most effective financial institutions that is around. So I think I'm quite optimistic that in that case, EIB will play a significant role.
Well, Werner, thank you very much for your time today. Hope to speak to you again soon. That is European Investment Bank President Werner Hoyer. Let's check markets. Market check now with Abigail Doolittle.
Well, Vonnie, it certainly is a risk-on day on this Tuesday, bouncing back after yesterday's relatively small declines, if you can call a 1% drop small. But what we do have on this day are gains of almost 3% for the S&P 500 and the Dow. The NASDAQ and the Russell 2000 are up more than 3%. This could reflect optimism that perhaps there are signs that the virus spread is easing, plus lots of talk about planning for reopening here in the U.S., and also maybe acceptance around what the IMF is talking about, that this could be the worst or will be the worst recession since the Great Depression. Now, where we also have a rally in Europe, yesterday closed for that Easter holiday, but today the Stoxx 600 up about 1%, so perhaps some of the same optimism. And take a look at that now in an official bull market from the lows earlier this year, up 20%. Some debate whether or not you should actually look at it from that standpoint, but from a technical number standpoint, we do have a bull market for the Stoxx 600. And then finally, Vonnie, we have some big movers here in the U.S., the banks, JP Morgan and Wells Fargo, and of course the news there, much larger loan provisions than expected in a long time. Jamie Dimon saying that the U.S. won't fully open until at least June. That's interesting commentary. J&J put up a strong quarter, so did Fastenal. So we do have some winners there. And at this point, though, Wells Fargo is trading back down. And interestingly, JP Morgan just flat at this point. But overall, risk on right here in the U.S., Vonnie.
Right, well, we have the perfect guest next to talk to us about this. That is Abigail Doolittle. Thank you. That guest, of course, legendary investor Laszlo Barini. He's been noticing some very interesting dynamics in the marketplace. We're going to get to him next. This is Bloomberg. Live from New York, I'm Bonnie Quinn along with Guy Johnson in London, and this is Bloomberg Markets. It's time now for your latest Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Bank of America has raised its price target for Netflix to one of the highest tracked by Bloomberg. B of A calling for shares to hit $460. Analyst Nat Schindler writes the coronavirus pandemic is a perfect storm for the online streaming service. He says Netflix has strong content, stay-at-home orders, suspended sports leagues and shuttered movie theatres, and that all works in its favour. In China, shipments of Apple's iPhones rebounded last month. Shipments rose 19% in March to 2.5 million units. That came at a time when China's broader smartphone market actually shrank by 22%. iPhone sales were hammered in February when the Chinese government imposed its coronavirus lockdown. And Intelsat is seeking a bankruptcy loan that would keep the satellite service alive. The company is waiting for billions in proceeds from the government spectrum auction later this year. And that is your latest Bloomberg Business Flash. Laszlo Barini up next. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg Commodity Indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Live from New York, I'm Bonnie Quinn along with Guy Johnson in London. This is Bloomberg Markets. We have an RBS exclusive now. The bank among UK lenders helping businesses through the coronavirus. So far, the government has paid out more than £1 billion to small businesses. But are companies getting what they need? We spoke exclusively with Chairman Howard Davies earlier.
It is very important because they do create a huge amount of employment in the country. And for many of them, of course, there's been a complete stop on their business. I mean, the most obvious ones being restaurants and hotels. But a lot more too who are in the supply chain for the leisure and tourism industry, or indeed for manufacturing industry, which is largely closed down. So it is absolutely crucial. I think the really key thing is that we need to ensure that there is productive capacity in the economy for when the opening up and the upturn eventually comes. Because if we've lost productive capacity because firms have just given up during the crisis, then we will have a constrained upturn. So it's both important on the downside, but it's also very important to position the economy better for the upturn.
How difficult is it going to be?
That was Matt Miller there speaking with Howard Davies, RBS chairman. So, Laszlo Burini Associates president and founder, a legend in markets partially due to his impeccable timing over decades. Well, he's been noticing some intriguing market action in recent days, and we should mention that he had been bullish for most of the last 10 years, but the last time we spoke with him, $500 in recent days and weeks. Laszlo, tell us what's been jumping out at you.
What you're seeing, much to my surprise, is institutions are buying, and they're buying aggressively in the S&P cash market. And it comes a little bit counterintuitive, but basically what they're doing is they're putting money out and they're buying aggressively.
So this is the chart we're looking at here. The blue line is the block trades, and you have the S&P 500, just, obviously that recent rally that we saw. So let's move to an historical one, Laszlo. This is between 2002 and 2004, December 2002 to June 2004. And we can see a very interesting pattern there too, and you can compare the two.
Well, what we're showing here is the block trades, the larger trades involving more money, trading on upticks. And as the market in 2002 was making a new low, people were buying. People very quietly, with stealth, accumulating shares. And then when the market kept going, they kept buying. If you notice the whole 18-month period, every time there was a downtick, every time there was a setback, people stepped up and bought. And this is probably the most positive indicator we've ever seen. In 2009, we put out a piece early a year entitled S&P 500 750, the bottom. Okay, the bottom at 660, we were 8% early, 6 weeks early, but this is showing you what the money is actually doing. And again, it's not our opinion. This is an analysis of every single trade that takes place. And what's interesting is that for the last several years, this has not been very useful because of high-frequency trading and all the issues going on. Now, the chaos of this market and the volatility, we're seeing institutions buying the old way, stepping up, buying stocks, and that's what's really driving the market. And the attitude that it's a short covering or arbitrage. No. These are people buying stock long. And if you can look at the S&P chart today, what you saw was as it was making a low, people were already stepping up and buying stock. And it reflects on a lot of individual names.
So, Laszlo, if now is the time to put money to work, as you say, and these charts are again, relevant and new, if you like, where would you be putting money to work? Where are the stocks that you find most attractive?
Well, I can't talk about where I'm doing it because of my lawyers would get a little upset. But let me give you a stock which will lead to eye roll, General Motors. If you look at the block trading in General Motors, people are buying General Motors aggressively. That is, they're buying it on the offering side of the market, they're creating upticks. And I sit there and like everybody else, I would be hard-pressed to come up with a reason for it. But again, we found over time, there's no better indicator of the market. And also, this is the only lead indicator of prices that we've ever found. So, General Motors, someone came to me and said they could make a case for General Motors, I would agree with them. And again, with some surprise.
Now, Laszlo, there are other stocks that are showing similar patterns. Talk to me about Exxon, XOM.
Same thing. I mean, we haven't touched the oil stock since 2016, and for whatever reason, whether it was the fact that people were bullish on the talks between Saudi Arabia and Russia, for whatever reason, somebody is in there. And again, it's not somebody; it's a lot of people. It's the market as a whole, and they're buying Exxon. Would I buy it? I mean, it's hard when you haven't bought a stock for 5 or 6 years. But again, what we're trying to do is show this is the voice of the market, not opinion, not a model. This is, again, a trade-by-trade analysis of large amounts of money.
So, speaking of car makers, we mentioned General Motors, but what about Tesla, Laszlo? That's been sort of trading separately to the market for the longest time. It's got, real sort of die-hard bulls and die-hard bears. What are you noticing from the Tesla chart?
The reason I mentioned Tesla is that if you look at it now, my attitude is, it's going up and down. The interesting thing about Tesla is if you go back to August and September of 2019, and you look and you see that stock basically went sideways for 2 or 3 months, and yet during that whole time, people were buying. During that whole time, for all the controversy and all the analysis, with their money, people were stepping up. And they kept buying, and they kept buying. And here was a stock that in less than 12 months basically went up 400%. And that's the power of this. This is, again, the market telling you that, this is where I'm putting my interest. And one of the great cliches, and a lot of cliches, so true, is don't fight the tape. And here is the ticker tape telling you that, this news is the so-so and Mr. Musk is controversial, but you see that at the point of attack, people are putting their money in. Now, to me, the stock goes up and down, and there's all kinds of concerns and dialogue. I wouldn't put a whole lot of focus on the difference in spread between the price and the money flow, but more on the direction. And you see it. There was some buying as it went down, and now it's down a little sloppy. But the whole point of the Tesla chart is that you went from $250 to $900 in 6, 7, 8 months. Not many stocks do that.
Well, one bucking the trend that you've been talking about, and I suppose we might anticipate this perhaps, is Starbucks. If you look at that chart, you see there's been actually a lot of selling recently, that blue line showing a real drop in selling, even as the stock has been ticking higher, Laszlo. What's the story there? Institutions and big investors just not buying the whole fast food and casual story?
Not necessarily. We look at it stock for stock. We don't say this represents anything. But the key point is there's a phrase in the market where you go sell in this strength. And that's what's showing in Starbucks. People are not taking advantage of lower prices. What they're doing is on the rally, they're selling into the rally. And we find over time that 80% of stocks, we realize that all 500 stocks in the S&P, 80% of them are neutral. 80% of them go up because they're being bought. They go down because they're being sold. We're looking for those 15 to 20%, whereas they go lower, people are buying, whereas they go higher, they're selling. And Starbucks is one of those stocks that, again, it could do okay, but Starbucks is not going to get up and run away. One of the more interesting recent examples we had was last fall when the Street was pretty much unanimous that you wanted to switch into value and cyclical stocks. And when we looked at the value and cyclical stocks in October last year, there was no buying. The market was not endorsing that conclusion, and so we stuck with the growth technology. And basically, what what we look for is what is the market saying? And all the analysts in the world can say, buy Starbucks, but if the market is telling you that people are selling it, listen to the market.
Listen to the market. Laszlo, thank you. Well, it is always nice to have an interpreter of what the market is saying. That is Laszlo Barini, legendary Laszlo Barini of Barini Associates. Thank you. Guy.
Body coming up, we're going to speak to GlaxoSmithKline's CEO about what its new partnership with Sanofi is going to mean in terms of the race to find a vaccine. That's next. This is Bloomberg.
This is Bloomberg Markets. I'm Dominique Quinn. Coming up later today, we're going to be hearing from former Treasury Secretary and Fed Chairman Alan Greenspan. This is Bloomberg.
From London, I'm Guy Johnson with Bonnie Quinn in New York. This is Bloomberg Markets. So Sanofi of France and GSK of the UK, two of the world's biggest drug makers, are teaming up to create a vaccine for the coronavirus. They aim to start human trials later this year. Glaxo will supply the so-called adjuvants, which improve efficacy of the vaccine's lowering dosages. Joining us now to discuss all of this, GlaxoSmithKline's CEO, Emma Walmsley. Emma Walmsley, thank you very much indeed for your time today. We greatly appreciate it. Look, the big question surrounding vaccines seems to be at the moment, A, getting kind of a suitable candidate, but then the big question beyond that is how does it get scaled and scaled in sufficient quantities that are really going to make a difference? How are you going to achieve the latter part of that?
Hi, well, thanks. And first of all, let me say on behalf of GSK, a huge thank you to all the frontline healthcare workers battling this and the scientists, whether it be in our own companies or around the world, who are trying to stop it in its tracks. As you say, we've announced today what we think is an unprecedented partnership of two of the world's biggest companies in vaccines, leaders in vaccines, with proven technologies in pandemic vaccination, whether that be Sanofi's antigen or the adjuvant that we used successfully in the last pandemic. And exactly as you said, the key of an adjuvant is that it can be antigen sparing, so you can get to producing more volumes and therefore protecting more people sooner. And if we're successful, there's an enormous amount of work to do, and we're still at early stages. But if we're successful and are able to accelerate the timelines as we hope to do, we should be able to get to hundreds of millions of doses by the end of next year. Now, that still means the world is going to need more than one successful vaccine, which is also why this is one of 7 partnerships that we've announced around the world, and wish every success to the other candidates that are developing here. So lots to do, but clearly getting a vaccine that is safe and works and at scale is our number one priority in terms of what we can contribute as solutions.
Okay, Emma, let's just talk about the scaling. Where do you see it being manufactured? Presumably this will be manufactured around the world. And where does the current manufacturing facility, where do the current manufacturing facilities exist that will allow you to scale it quick enough?
Well, we're obviously contributing the adjuvant here, and you're completely right. To get to an urgent solution here, we need not only partnerships, we also need a global approach. So in terms of the adjuvant side of things, would expect to be manufacturing in the US, Europe, potentially even the UK, but that's something that's under ongoing review at the moment, because obviously we have to prepare a degree of capacity at risk. And our goal, I'm sure with the multiple vaccines that will come forward from us and for others, to make sure that we can support access globally, initially to those that most urgently need it, the most vulnerable or indeed the most exposed, but also make sure that we have access not just to developed economies, but for some of those developing economies that are going to be very hard hit by this, and often with more vulnerable healthcare systems.
Yeah, you've said you're going to be very equitable when it comes to supplying poor and richer countries. Emma, how do you plan on doing that? How will you make that work?
Well, first of all, this is a global challenge of epic proportions, and again, the world will need more than one vaccine to make sure that we can supply everybody that needs it. And our goal, obviously, this initial partnership is supported also in part by Sanofi's work with BARDA. We hope to engage as urgently as possible with global governments, also on GSK's side in terms of our approach across our collaborations. We do expect to donate a certain volume of our adjuvants, and we'll do this by governments and institutions that are committed to access, particularly supporting delivery in the front line. And that means that in developed markets, we'll also be pricing responsibly, as we have a good track record of doing.
So it sounds like you're going to have to prove something to certain governments in order to get some funding. If that's the case, Emma, how will you go about proving that you will have a vaccine on time and that you'll be able to scale up to the necessary amount? Are you going to be converting factories? Are you going to be taking resources away from other drugs?
Well, first of all, you're completely right. Whether it be in therapeutic treatments or in any candidate vaccines, there's a lot of work to be done to make sure that we have the data available, and that's why we have to go into clinical trials to really prove the safety and the efficacy of this candidate. Where we have some confidence, I suppose you would say, recognising it's still early stages, is these, both the antigen and the adjuvant are proven and licensed. But obviously we still need to go through those scale clinical studies. And our experience today, and we're seeing that in tremendous mobilisation from the regulators, be it on the therapeutic side or indeed on vaccines work, is the world is mobilised now to try and get to a solution or solutions as soon as possible. So obviously we'll be data-led, and inevitably some of the candidates brought forward won't work, and then we'll be agile around resources to make sure that we're focused on ones that have the highest potential to do so.
Emma, the virus seems to be affecting the elderly more than the younger generations. how do we find a mix in terms of the level within the vaccine, the kind of the strength of the vaccine, to make sure that it kind of helps with elderly people in sort of more compromised immune systems, but doesn't ultimately end up harming younger generations in terms of the dosage?
Well, I just repeat what I've already said, which is that safety is always critical with vaccination, because by definition you're talking about preventative care, whether that be with new babies or with seasonal flu vaccines or shingles vaccines. We're always talking about protection. So the dosage question is one of the key things that will be being reviewed through the clinical studies that come up to make sure that we get that balance right. And then as production comes through, obviously the goal will be to protect the most vulnerable, be that because of age, other issues, or indeed those that are the most exposed, for example, healthcare professionals and carers in the front line. So that will be the goal of some of the work that lies ahead in this and in other partnerships and across the industry.
Emma, you're going to be competing, even with your partners in this, you're going to be competing with other groups of pharmaceutical companies to try and, get your hands on government money, agency money, institutional money, and so on. How do you do that? How do you get your foot in the door first, as it were, to get more money so that you can do all of these great things that you're planning on?
Well, first of all, I think the competition here is against the virus. This is not the time to be, and I'm really not seeing evidence of that. I'm seeing multiple evidence of the industry stepping up together, whether that's being in pooling assets review as we have done in the therapeutics accelerator to make sure that we're screening things that could come through. We're going to need more than one solution here, and I think as we've seen with economic interventions, governments worldwide are recognising that we need to support credible proposals in terms of funding to get to a solution here, because the cost, be it from a healthcare point of view, an indirect healthcare point of view, or a social point of view as a consequence of the economic impact, is so enormous. I think, credible candidates that can come at pace and at scale will be being supported. And like others, we just want to do the right thing, be driven by data and science, and see it as a competition against the virus, not each other.
Emma, bring us up to date on what the experts and your experts are telling you about a vaccine. Will it be something that only works for this particular strain of the coronavirus? If it comes back in the fall or indeed next year in some small mutated form, will you need to then develop yet another vaccine?
Well, it's a very good question, and there's an enormous amount about this virus that's still to be learned, but there's good exchange of data, and we need to be able to understand how it may or may not mutate. But again, that's also why there's an important role for therapeutics here, and indeed that part of the investment that both industry and I know governments and other institutions are looking at is how we get to better pandemic preparedness, because it is unlikely that this is, the only pandemic that we need to be ready for, and we'd like to play our part in making sure the world is a bit more ready next time.
Emma, can you just give us your sense of where we are in terms of test scaling? When do you think that we are going to be seeing scaling of the antigen test that is going to really kind of match up to expectations? And when do you think actually we're going to see a realistic kind of date for a scalable antibody test that will tell us all whether or not we've actually had the virus?
Well, we're not a diagnostic company, so I think that's a question better answered by.
But what is your? But you talk to a lot of people, and you work with a lot of scientists. I'm just curious as to what you're hearing.
So listen, we are like many companies. As we lead through a crisis like this, the first thing we do is worry about our people. Then we worry about business continuity, and I've got 70 factories running with more than 20,000 people going in every day to supply essential drugs. And then the third thing that we do is we worry about how we contribute in terms of solutions. We're doing that at scale with our vaccines and with our therapy work, but we're also trying to engage where we can in practical help. And we are supporting the UK government's testing work in a collaboration with AZ and Cambridge University, and we're doing a similar thing in Belgium with our labs there. And that is very much focused, as we've been requested to, on the PCR testing. And being part of the government's efforts to scale that as soon as possible. And we do think in the UK we will be heading towards about 30,000 throughput a day, which will be a contribution obviously to the national goals when that's fully operational early May. Obviously, I mean, at this stage we're not working on any of the antibody testing, but that will be something that will be necessary as we think about what's required to get to I suppose you should say a full and complete exit.
Yes.
The first thing that's going to be required is a sufficient scale of vaccines, and of course a degree of antibody testing, and arguably effective tracking and tracing to support that healthy and paced and disciplined recovery from lockdown. And in the meantime, we'll need to find effective ways of managing through it. But I know the government.
Our thanks to you. That is GlaxoSmithKline CEO Emma Walmsley, and of course the very best of luck. We all hope that it all happens rather quickly. Markets are higher by 2% apiece now. The Nasdaq up 3%.
Okay.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
From London, I'm Guy Johnson. Bonnie Quinn's over in New York. We're now counting you down to the European close here on Bloomberg Markets. Quick look at where we sit here in Europe. Equities off their earlier highs. The DAX has had some technical issues to deal with today, but seems to be back and functioning. We have a bid on the German bond market. We've got an offer on the Italian bond market. We're seeing the BTP Bund spread kind of 207, 208. And it's interesting. Volatility continues to come down. We're just north of 40. It's a similar story over in the States. Vonnie.
I just want to let you know that we are getting Boeing orders, first quarter orders and delivery figures right now. It appears that Boeing booked 49 orders in the first quarter, including 29 Dreamliners. 31 orders in March, including 12 787 Dreamliners. Now, we know that Boeing had already lost orders for about 150 MAX jets in March because of the coronavirus pandemic. 150 cancellations, and that included 75 previously announced. So the likes of Avalon, for example, we knew that they had announced some cancellations. The stock is down about 0.3%. We had been anticipating that we'd get those numbers today. So once again, Boeing lost orders for 150 of its 737 MAX aircraft last month. This as air travel plunged amid the coronavirus pandemic, and of course lessors as well as airliners all cancelling. It did book 49 orders, though, in the first quarter, including 29 Dreamliners. So as you can see, elsewhere we are rallying here for the S&P 500. There's just one sector in the S&P 500 lower today, and that is banks. We'll get to a conversation on their earnings in just a few minutes. We had JP Morgan and Wells Fargo out today earlier. Crude oil down almost 5% again. It can't catch a break these days, 21.36 a barrel, and the 10-year yield at 74 basis points. Guy.
Okay, let's talk a bit about what is happening here in Europe and around the world, equity markets and the virus story. So we are starting to see maybe some indications that we are seeing a plateauing in the number of cases in certain countries across Europe. We're also starting to see some countries reopening their economies, albeit tentatively Austria, Denmark, starting to ease their lockdowns. However, we are seeing countries like the UK and France and Italy extending theirs. Let's talk to Peter Gonry. He's the head of equity strategy over at Saxo. Joins us now on the line. Peter, we've seen a significant equity market rally. We're seeing more of that today. My question to you is there a greater risk that we get more upside from here, or a greater risk that actually we retrace these recent gains?
I think we will retrace these gains. I think the downside risk is bigger than the upside risk at this point in time. I think the S&P 500 and European equities are trading on sentiment on a faster recovery, and I think will most likely happen. I think there will be many false starts in reopening the economy. I think that's already the early lessons that we are seeing from Asia. We did a study yesterday. We're looking at these dividend futures. If you look at the expected dividends for 2021, the market is pricing in $43 per share, so that's almost down 30% from current levels. If you use a fair range of different valuation multiples that we have seen over the past 30 years, the fair value on those fundamentals, expected fundamentals, is around 2,300 in the S&P 500. So clearly, the only thing, if we believe markets are efficient and the S&P 500 is right, but the dividend futures market is also right, the only sensible explanation for what's going on is that investors are buying the Fed put, and they are willing to pay a higher valuation multiples on cash flows than we've seen in recent years, because simply the Fed is crushing yields in credit and government bonds, and that might be what is explaining this rally. I just don't think it's sustainable, to be honest.
Okay, let's talk a bit about what may undo it. The earnings season. JP Morgan coming out today. It's booking some pretty big provisions in terms of credit losses that are anticipated as a result of the virus. What are you expecting from earnings season? What kind of numbers do you think are going to be posted? And in reality, given the fact that the last period, the rearview mirror, only really kind of has a month of serious virus impact in it, how useful are these figures?
Well, I don't read too much into I won't be reading too much into the Q1 numbers for many companies. It's the outlook that is important. And if you looked at the JP Morgan and the Wells Fargo earnings releases, they say in the press release that they only give Q2 guidance, basically. There is no guidance for Q3 or Q4 the rest of the year. So basically, and I think that will be the case for many companies, so we'll be flying blind so to speak. We don't know what's really coming. And JP Morgan Chase share started up in the early session, and it's now down 3% during the conference call. And I think maybe Diamond's comments about that, a fully reopening of the U.S. economy will not happen until maybe late into August, I think was somewhat at odds with what the current market pricing is. But as you said, the credit provisions, they're jumping, and they're jumping very fast. The biggest jump since 2008, and it's specifically in the consumer cards business. And I'm profoundly shocked to see that MasterCard and American Express stocks are, at least the last time I checked, was up today, because the credit provisions that we're seeing from JP Morgan Chase in the credit card business, and the news that are coming out from China in the exact same space shows you that we're hitting a wall in this market. So I think MasterCard and to a certain less extent Visa, but in American Express, they're in for a very tough year, maybe 2 years. Will be hangovers, and I think we look at certain turning point indicators, and we would like us to be confident about this rally. We would like to see financials outperform utilities, and we are still in the basement on that spread between those two sectors. And this rally hasn't been carried by financials, so it's not the credit outlook that has improved. Yes, the Fed is buying credit, but the genuine real economy credit outlook hasn't improved. It's driven by technology and online businesses that are to some extent immune to what's going on in the real economy. But I don't think we have much more left to go here in the equity market.
So, Peter, the amount of loan loss provisions that we saw today out of Wells Fargo and JP Morgan, should it be a leading indicator for us as to the health of the consumer in 3 to 6 months? Or should we just read this as, Jamie Dimon protecting his fortress balance sheet for the future?
There's probably an element of both. I think the real test for the market and also the earnings will be when we hit July, when we get the Q2 numbers, because the Q1 numbers, there's still a lot of uncertainty. As you also pointed out, the sell-off started in February. The real toll on the European economy and the U.S. economy only happened in March. I think Q2 will be the real test, and I think the market will be shocked to see what banks will have to set aside for credit provisions. I mean, all the various economic forecasts for the unemployment rate in the U.S. is looking at around in the range of 20 to 30%. So consumers will be hit hard, and I think a key to the equity market here is what kind of recovery profile we're looking at. And I think we at Saxo probably leaning towards some kind of a hybrid between a U-turn or an L-shaped recovery. So we're not in the positive camp here on how fast things can go. So I think it'll be worse for financials before it gets better. But if you looked at the LQD ETF that tracks the investment grade bonds, you wouldn't believe that we have a global pandemic and then a 100-year crisis in the economy. I mean, it's almost back to the highs before the sell-off. And as you also pointed out, guys, before we went on the show, the Italian-Germany yield spread is also widening. I think that's also, a small signal in the, rally and noise from the equity market that something is not really adding up here, even in Europe. I really wonder whether Europe can survive this shock unless we go full on the Corona bonds. But so far, the Germans and the Dutch politicians are not really. They don't really want to play ball with the Italians and the Spaniards.
Peter, will we know from balance sheets who will make it and who won't? Will we know from this set of earnings which companies will struggle? And even the multinationals, retailers, you mentioned several of them.
Yeah, retailers will obviously suffer. Every business that is not strong on online within the consumer space will suffer. That's also what we're seeing here in Europe. To some extent, you can see Adidas has performed worse than Nike. They are a little bit more worse off in their online business. You have the same with the H&M have done worse than some of the more online strong businesses like Zalando. That is going to be the trend. But I think yesterday's session was very odd in the sense that if you look across the different equity factors, a lot of the quant funds and equity managers that would like, in a typical environment like this, to have overweight to what you call the quality versus the junk factor, right? So you want to own the quality companies and not the junk companies. But if you look at the session yesterday and in the previous 2 weeks, it's actually been the junks that has performed very well. In the U.S. yesterday, junk was up 3% and the S&P cash index was down 1%. So, and that's all due to the central bank policies, especially the Fed announced on Thursday buying junk bonds, it's lowering the financing rates for weak balance sheets. So I think people have to be extremely careful how they play this. But and it's basically bailing out the publicly listed companies and not the real economy. So I think that we'll see more bailout packages coming because the real economy is not really the publicly listed companies, for sure.
All right, Peter, thank you. That is Peter Garnery, Head of Equity Strategy at Saxo Bank. Let's check global markets now with a deeper dive. Here's Abigail Doolittle.
Bonnie, we do still have a risk-on tone from a stock perspective here in the U.S. and somewhat in Europe. Europe is a bit mixed, but the U.S., we have the S&P 500 right now up about 2% off the highs when it was up closer to 3%. You can see one reason why the financial is now down about 0.9%. Earlier, up 2.4%. Initial reaction to bank earnings was positive. Now investors really taking into account the severity of those numbers. You can see the stock 600 in Europe up 0.8% off of its highs of 1.4%. And the banks there in Europe also weak. So off of the highs, but we do mainly have gains. And this is reflected in the volatility indicators that you and Guy have been talking about. Take a look at the VIX index here in the U.S. It is below 40, the first time we've seen that in more than a month. So volatility is coming off. Interesting, though, when we go cross-asset class, it's not risk-on. We have the yen higher for a fourth day in a row. That dollar-yen is falling. We have gold. Gold had been higher, so not as much of a haven bid there, but that's really fitting to the commodity complex, another group of risk assets. Those are lower. That basket is lower, especially take a look at crude oil, down about 6%. So, again, a nuanced risk-on picture here. And then finally, certainly risk-on, though, Amazon, Guy, hitting an all-time high, really pretty incredible. This stock up more than 20% on the year as Americans and people around the world are simply ordering supplies into their homes, Guy, during this coronavirus crisis.
Does make you wonder, though, whether Amazon's going to have to pay its staff a little bit more at the end of this, or maybe a lot more. We'll see how that affects the multiples. Coming up, we're going to get an update on how the aviation industry is dealing with the coronavirus pandemic. Alexander Duzhuniak, Director General of IATA, the International Air Transport Association, is going to be joining us. And later today at 4:30 p.m. in New York, 9:30 p.m. in London, Bloomberg is launching Leadership Live with David Rubenstein. Today's guest, Marriott CEO Arne Sorensen, he's going to be joining us. This is Bloomberg.
The bad economy has very adverse consequences way beyond just the economy.
in terms of mental health, domestic abuse, substance abuse, etc. So a rational plan to get back to work is a good thing to do. And hopefully it'll be sooner rather than later, but it won't be May. So, you're talking about June, July, August.
JP Morgan CEO Jamie Dimon there speaking today on that earnings call with investors, sharing his thoughts on when the U.S. economy will fully reopen. Joining us with more now on JP Morgan's earnings is Bloomberg's Sonali Basak. Everyone has been obsessing a little bit about the loan loss provisions, Sonali. Is that what the street is really taking account of today?
Bonnie, these provisions are certainly significant. They're much more than what Wall Street was expecting. And what's worse is that they may get worse in the coming quarters. Now, this morning, the market shrugged off some of these issues because other areas of the bank were really able to shine, like trading. But you don't know how long this is going to last for and how it will continue to impact not only loan loss provisions, but the low interest rates might impact their ability to collect net interest income on the top of that.
We don't really have much to go on at this point in time. I'm going to ask the broad question, Sonali. How useful are these numbers? We've had a month in which we've had an impact coming through of the virus. Jamie Dimon and the rest of the team, they don't have much visibility here on what is going forward. How rough are the estimates that we're getting in terms of the forward-looking components, particularly as Bonnie says, when it comes to the credit side?
Listen, Guy, it's better than nothing, right? When you have $1.4 billion in provisions a year ago and then more than $8 billion now, it's a significant change. And you see JP Morgan really trying to get ahead of the issue and give Wall Street estimates on how bad it can really get and not try to sugarcoat how bad it can become. With all of that said, you see all the banks here outlining their exposures across all of the different sectors: entertainment, oil and gas, travel. And that's the question. Some of this is COVID related, some of this is oil and gas related, and the volumes that propped up trading in the first quarter, none of the banks can really give us an expectation on whether that will continue to prop up the bright spot, which was trading.
What do we anticipate from these results, Sonali, for the rest of the banks this week, particularly the bulge bracket banks?
Tomorrow morning, Bank of America will be extraordinarily telling because Bank of America also is very heavily weighted for the consumer, and it also is very highly dependent on net interest income. So we'll be watching to see what their income expectations are this year. Remember, Wells Fargo didn't tell us exactly where they'll fall at the end of this year, and at JP Morgan at $55 billion, they might be still above where they were 2 years ago, albeit lower than they were last year. Morgan Stanley and Goldman Sachs at Goldman, what will be interesting is their principal investing at a time where they're building another $10 billion war chest to put towards private markets. People are looking to ramp up opportunities, but again, things have not quite evened out in this market yet enough for people to really dive in.
Yep, it's going to be a busy week. How much are we really going to learn? We will wait and see. Sonali's going to give us some great coverage throughout the week. Sonali Basak, thank you very much indeed. This is Bloomberg.
Live from New York, I'm Bonnie Quinn along with Guy Johnson in London. This is the European Close on Bloomberg Markets. The International Monetary Fund is predicting the great lockdown recession will be the steepest in almost a century. Earlier today, Bloomberg's Jonathan Ferro spoke with IMF Chief Economist Geeta Gopinath.
Our baseline is that the crisis, the epidemic, will be concentrated in the second quarter for most countries in the world, and containment measures will also be concentrated in the second quarter, and then there will be a gradual removal after that. And so we will start seeing initial signs of a recovery in the second half. That's what's in our baseline, but we also have more adverse scenarios.
Well, let's talk about where you see that more pronounced. Are you seeing that being led by countries like China, like the United States? Is it a first-in, first-out situation, Geeta? How do you expect this to build in the coming months?
So China, of course, was the epicenter of the pandemic, and it was hit severely in the first quarter. And so we have a very deep contraction for China in the first quarter. Now, we're seeing signs of recovery, but no, it's not back to business as usual. It will also, for China's growth, what will matter is what's happening in the rest of the world. While containment measures are coming off in China, there are still very severe lockdowns in many parts of the world, and that could be extended. And emerging markets are still at the beginning of this whole pandemic. So for the global economy as a whole, it matters a lot what's happening everywhere in the world. But if our baseline is right, which is that most of this will be concentrated in the first half, then we should start seeing stronger recovery starting in the second half of this year.
Just on the forecast themselves, Geeta, in an environment like this, and for many economists on Wall Street, they're struggling with the same thing. Just how difficult is it to throw out a forecast when you've got no real precedents right now for reopening and establishing normalization?
Oh, this is really unprecedented. I mean, usually we like to rely on historical data and analysis to come up with projections, but when you don't really have much data from a period of a pandemic, that's very hard to do. And also, usually when you have a shock, it's like a housing crisis or a bursting of a financial bubble. Now, that's something that we know about and have seen in the past. Here, we have to rely on epidemiologists and public health officials to tell us how this virus will evolve, what kinds of therapeutics and vaccines might come about. So this is very, very difficult. The way we're thinking about it is that we know that as long as these containment measures are in place, some sectors are much more severely hit than others. And those will be travel, tourism, entertainment. And so if you're a country that relies very heavily on these sectors for your growth, you're going to be very badly hit. But this is not just a health crisis, because this is also a financial crisis and a commodity price collapse. So for emerging markets, their vulnerabilities are magnified with big reversals in capital flows and currency pressures. So this is a very complex set of crises to think about.
Yeah, and Geeta, it's on the latter point that I want to pick up on. I don't think we've really quite understood the shock to EM yet, and I don't think we've really seen the shock wave through EM and back into the global economy just yet. What are you expecting to see play out in emerging markets in the coming months?
I actually see that as one of very major downside risks to our baseline, which is that things could get a whole lot worse in emerging markets. Now, we are assuming in our baseline that emerging markets will have a more severe health crisis than what we are seeing right now, but not at the same level as what we've seen, for instance, in the euro area or the US, in terms at least of containment measures. Now, that could change. That could be very different. Secondly, it's not just the health crisis. They have a big collapse in external demand. They have a big reversal in capital flows coming into their economies. And if you're a commodity exporter, you have a major drop in commodity prices. And they're starting out with much more fragile health systems, much higher, very high debt levels. And so these can compound the problem. And so I think that is one area where the downside risks are severe, and why it's very important for the international community to pay very close attention to emerging markets and low-income countries.
And that was Geeta Gopinath, IMF Chief Economist, earlier on Bloomberg Television. Let's check US markets now, because we have been seeing a nice rally today in all stocks, save for the banks. Right now, we're just off our highs, with the S&P 500 up a full 2%, the Nasdaq up almost 3%, the Dow, though, just up 1.6%, and that is really primarily because of those banks reporting today. The VIX, a little less elevated, it's at 38, signaling a little calm to the markets. The yen trading at 107.19, and Boeing, after those orders came in earlier, is recovering. It had dropped down by as much as 2%. It's down 1.6% now. It's still a difficult day for Boeing investors once again, guys.
Seeing exactly what the company has to say. European markets look a little bit like this. Look, we had a bit of a technical issue with the DAX earlier on. It is, though, now up and functioning, and up being the opposite word. It is outperforming, as you can see. It's up by 1.68%. In terms of where we are seeing weakness today, we're seeing it in the travel and leisure sector, oil and gas down, which accounts for why we are seeing the FTSE 100 under a little bit more pressure than most. As you can see across Europe, it is the underperformer right now versus the majors. In terms of where the points are being taken off, it is in the oil sector. So BP knocking 11 points off, Shell is knocking 10 points off, British American Tobacco, not in the oil sector, knocking 8% off, and then we're seeing some of the travel and leisure stocks under pressure, plus some of the banks. The healthcare stocks are catching a nice bid today. So AstraZeneca up really quite nicely. GlaxoSmithKline also trading higher. What we are seeing, though, this afternoon is a widening out of the BTP Bund spread. Pay attention to that. It is worth watching. We're now up to around 214. We're not at the levels we saw around a month ago, but it is worth. In Europe. The European close is next. This is Bloomberg.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's heavily won in a lot of ways. Running Microsoft was just kind of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
Seconds to go until the end of regular trading here this Tuesday in Europe. We're back. Had the day off yesterday, but European markets have returned today. Volume's okay relative to the last 100 days, down on the last 30 days. We're near session lows, as you can see, when it comes to the equity markets across Europe more broadly, the Stock 600, and the breadth is actually reasonably balanced. We've got 306 stocks up, down 292, so a reasonably balanced market. But in terms of where we are seeing the damage done, it is in the oil and gas sector, and that is disproportionately having an effect on the FTSE 100. As you can see, the FTSE 100 is down by around 0.9%. We do have a currency factor that is worth bearing in mind. The DAX is catching a bid today despite some technical difficulties. The CAC 40 splitting the difference up by around 0.5%. But if you take a look at the DAX throughout the day, you get an idea of the kind of problems that we've had, and at times like these, not really welcome. Large portions of the day, we didn't get a price on the DAX. Thankfully, though, the technical glitches, the gremlins, have gone away. We are now back trading to the close, and as you can see, like other markets, fading the earlier rally. In terms of the way that we are breaking the story down from a sector point of view, we are seeing some of the healthcare stocks catching a bid today, names like AstraZeneca and Roche catching a bid, but it's the bottom end of the market that is probably worth focusing on a little bit more. Brent crude is currently trading down by around 5.2, 5.3%. TI over in the United States down over 6%. The Saudi king, well, he says he's satisfied with the OPEC Plus deal. The market seems to be taking a slightly different view of the cuts that have been announced and how credible they ultimately are. And that is certainly being priced into A, the crude market today, and B, into the oil and gas stocks here in Europe. You can see the big losers. But in terms of the sector story, reasonably balanced here in Europe, and volatility continues to fall.
Well, we have an update going on here in the United States, except for a couple of industries, banks being among them. So if you look at the S&P 500, you'll see that overall it's up 1.9% off its highs of the day. About 100 stocks in there are lower. Many of them are in the oil and gas fields. As you can see, crude down another 6% today at 21.10, so that's why they're down. Banks, though, after earnings, also feeling the pain today. That index is down 3.73% in the S&P 500. Take a look at the 10-year yield. It's at 74 basis points. We're firmly in that range. And the VIX is below 39 right now, so a lot of cooling going on there in the VIX. But let's take a look at the industry groups, because you'll see the retailing index is up 3.5%. It's the best performer right now in the S&P 500. In fact, all of the groups in the S&P 500 are higher, except for that banks index. Some of the worst performers in the banks index include Huntington Bank shares, down about 5.8%. America. Citigroup not doing so great either, down 5.9%. Regions Financial and, of course, Wells Fargo and JP Morgan Chase are doing their bit to drag on stocks after loan loss provisions skyrocketed and net interest margins disappointed, among other items in those earnings, Guy.
Absolutely. Connie, you were talking about Boeing a little bit earlier on. Let's get back and talk more about what's happening in the aviation industry today. The International Air Transport Association said it expects airline ticket revenues to drop 55% in 2020. That's 25% more than the previous forecast. Airline traffic will be down 48%. For more now, we're joined by Alexandre de Juniac, Director General at IATA and former CEO of Air France KLM. Nice to speak with you again, Director General. Let's talk a little bit about your current forecasts. I'm really curious. The numbers seem to be getting worse and worse and worse. How close are you now to your kind of worst case scenario?
That's probably the most difficult question for us. We have worse than our figures every 3 weeks, considering the set of measures that have been implemented by governments and the length of the possible travel restrictions that they have announced that has been extended from weeks to months, and the fact that in addition to these restrictions, we have a very strong recession coming on top. So if you add the restrictions to travel plus the recession, plus the fact that we see some very strong economic impact, negative impact, we expect a recovery which will not be a V-shaped curve, but a U-shaped curve. So something pretty longer and probably slower than we should have expected even a few weeks ago. So to tell you, I think that the $312 billion loss of revenue that we have published this morning is not perhaps the last figure, but we are approaching our worst scenario.
Okay. Well, I look forward to speaking with you again, and I'm hoping at that point that, as you say, the rate of change in terms of the revisions is beginning to slow, because these numbers are incredibly dramatic. Let's talk about the return to service that you are anticipating. You see the sequence being domestic, regional, intercontinental, in terms of the way that flights will return. You don't see, though, domestic being up and running in terms of flights resuming until Q3. That does make me question, at what point do you see intercontinental travel returning in serious fashion?
We have prepared a restart plan, and perhaps the most difficult part of this restart plan, the most unknown territory on which we have to work, are the list of restrictions on travel and the opening of borders, because the end of restrictions and these openings, they crucially depend on the sanitary or health control measures that we will have to implement following the guidelines of the health authority. And so what we have expected and we have planned is a phased approach in which we will start with domestic, then we will continue with regional, then continental, and then intercontinental. So, and when you hear some forecasts done by head of state saying that, for instance, the Schengen borders will probably stay closed until the end of summer, you can expect that the return to intercontinental, a significant relation, will not happen before Q4.
So, Mr. de Gignac, you represent, about 300 airlines in 120 countries or so. I want to ask you for your reaction to Larry Kudlow's comments literally in the last couple of minutes that any aid to airlines, US airlines, would need to entail a taxpayer stake. So if US airlines get some aid from the government, taxpayers should get a stake. Would you be in favour of that kind of an arrangement?
I will tell you, we have no preconceived conclusions. We desperately need the aid of governments, and we thank governments because they have been very open. But we leave to governments the potential solutions they want to implement. It can go from credit loans to facilities, cash facilities, to guarantees, to capital injection, even to capital increase. So the best solution is probably adapted to the situation of each company. So if one solution is to take some stake in some airlines, it's possible. If it's not needed, it's not obvious. So we have to implement customized or tailored measures adapted to the situation of each airline and of each country.
Yes.
In which, the structure of the ownership could be different from one country to another. So we have no preference. Mm-hmm. We desperately need some cash. That's the point. The key point, the urgency for this.
Are your members concerned that some of them will get a better advantage over others in this time, depending on, where they're situated and who their governments are and the type of policies they implement? Is there anything you can do to ensure, a level playing field, as it were?
What we say is that we of course would like the government intervention to be fair, and not to give some non-justified advantages to some airlines compared to another. But we have to recognize that, considering the emergency in which we are, what we need is a government intervention to save our members, whatever is their situation. And of course, at the end of the day, we will see if everything could be have to be fair, have to be balanced, if it needs some capital injection, and so as a consequence, public participation.